Generally, this working capital finance, sometimes merchant banks now arrange the working capital finance, a service traditionally provided by the commercial banks. So generally, the merchant bank clients are corporate companies. For them, these merchant banks offered working capital finance to their companies. So this is also provided by the commercial banks, even though merchant banks also they will provide. And stock exchange brokerage. So merchant bankers act as a broker, first of all. So I already introduction only I explained. So these merchant bankers, they were act as a financial advisories and consultancies. So like that, the stock exchange brokerage means merchant bankers act as a brokers buying and selling shares for the clients. So for the clients means what here? Corporate companies. Conducting equity research and advising on investment timing and quantities. So here, behalf of the clients, behalf of the investors or behalf of the merchant bank clients, so they can buy the shares in the stock market. So they can act as a broker. So, and they can conducting the research, equity research and advising investment timing and quantities for his clients. So that is also. Next, capital restructuring. They assist companies with capital structure analysis. Mergers is whenever when the companies are going to merge, or when any companies take over to the other company, or diversification strategies and implementation of support. This capital restructuring purpose, these merchant bankers, they're going to give their valuable suggestions, advices to the corporates. So these are the key services offered by the banks, and remaining services also we'll discuss. So corporate counseling, providing guidance on diversification, market analysis, and revival of sick units through the detailed corporate law analysis. So corporate related counseling also, these merchant banks, they are going to offer. And issue management, managing capital issues by the coordinating price issues, post issues, post issue activities, ensuring legal compliance and smooth capital transfers. It means raising of capital, and whenever they receive the enough capital, is it okay? If they received excess capital, what is the decision they will take? And if they receive the low capital, what step they are going to take? These related all the advices will given by these merchant banks. Loan syndication and leasing. Generally, preparing a loan application for the short-term, long-term credit, managing euro issues, and facilitating leasing contacts between lessor and lessee. So this can they can simply, I can say that they are going to prepare the application for the short-term and medium-term loans, and managing the euro issues and facilitating leasing contacts. So these all are services which are provided by the merchant bankers. And what is the qualities required for the successful merchant bankers? So what is the qualities required for the merchant bankers? Generally, every merchant bank, they require analytical ability. Most analysis required in technical side and financial side and economic aspect also. Aspects of industry projects effectively. So they need to concentrate technical aspects, financial aspect, economic aspects, and industry project effective, whether in how the project is there. That analytical ability compulsory required by the merchant bankers. Next one is the abundant knowledge. So here, the merchant bankers they are very professional. They are very professional. They have depth knowledge. So they need to deep understanding of capital market, stock trends, investor psychology, and economic changes. So that is the reason abundant of knowledge they required. Innovative approach. See, instead of same method and instead of existing method, they need to develop the new capital market instruments to meet evolving investor needs. So he nowadays the market is the market consists very high competition. So there are merchant bankers also very high to hold the customer, to hold the client, sorry, to hold the client, we require special unique talent. So innovative approach manner, we have to innovative approach model, we have to develop the capital market instruments to meet the evolving investor needs. Next one is the integrity and professionalism. So maintaining high ethical standards and build strong client relationship with all with the full commitment. So that indicates that integrity and professionalism. So customers maximum, clients maximum, they are going to depend on their advisory body only. So that is the reason we have to maintain the professional, and we have to integrity, we have to be ethically and maintain the high ethical standards and build a strong client relationship for the full commitment. Then only you are able to continue with your client for a long period. And what is the challenges? What is the challenges of merchant banking? What is challenges faced by merchant? What are the challenges faced by merchant bankers in India? See, here, first of all, there is a high capital norms. High capital norms. SEBI required minimum net worth of the 1 crore rupees and restricted entry for the small but specialized in the professional. So high capital is required to start this merchant banking. As per the guidelines of the SEBI, these merchant banks can work. But for all the financial institutions, they cannot start the merchant banking operations. Compulsory, they need to maintain as per the instructions which is given by the SEBI, that minimum they have to follow. Then only they are able to operate their authenticated, they become authenticated institutions. So here, high capital norms, SEBI requires minimum net worth of 1 crore rupee to start the merchant bank. Restricted entry for small but specialized professionals are required. At the same time, non-cooperating firms issuing the companies. So merchant bankers face the difficulties in security allotment and refund process due to lack of cooperation from the issuers. So there is some disturbance we found that the issuer and merchant bankers. So they cannot refund the proper amount, whatever the securities allotted by the merchant banks. So issuer cannot repay that. That is the one of the problem facing by the merchant banking. And activity restrictions. SEBI limits merchant bankers mainly issue related activities and forcing same to separate or restrict their services. See, merchant banks generally, SEBI said that issue related activities is separate and other other operations, other financial advisory operations is separate. So this activity restriction is also facing by the merchant bankers. Yeah. So this is the story about the merchant bankers. Next one. Yeah. Next chapter, I'll explain. Next chapter, I'll explain that. Credit rating agencies. Yeah, I'll share that. Yeah. Next chapter is credit rating. Right. So, uh, right. What is the meaning by credit rating? What is the history of, what is the overview of the credit rating? First, I'll tell, then we'll go over to discussion of chapter content wise. See, credit rating means what? Generally, people can see that credit score, CIBIL score. Okay. So CIBIL score means what? Generally, banks, why they will look for the CIBIL score? For the that CIBIL score indicates that repayment ability of the person and the ability of finance maintenance of the person. So this credit rating generally it began in US in 1909 with the John Modi first rating. Today this rating agency operated worldwide and it is included in India also where the credit rating started in 1998. It what is the purpose? It helps to investor assess the business and payment risk. So, for example, one company is there. Whether generally investor always very much interested to know about the company performance before is investing. So, after analyzing of company performance, generally this credit rating agency they will give the one rating. Based on that rating, investor can able to know the performance and the ability of the company. So that is the reason we are going to see the, we are going to read the, to know the performance and ability of the repayment and payments of the business, we are going to give the credit rating. So this presentation covers meaning and importance in nature, instruments, and this topic covers advantages, limitations of credit rating, provide a comprehensive overview of the vital financial tool. First I will explain that meaning of credit rating. What is the meaning of credit rating? So credit rating is an expert opinion on issuer's ability and willingness to meet the debt obligations fully and on time. So it means what? It is a expert opinion, means agent opinion. It indicates that willingness to meet the debt and obligations of fully and on time. So it is an independent. Generally, this rating, credit rating agency or credit ratings, they are independent. Independent assessment, guiding the investors, not recommendation to buy or sell. So generally, based on the company financial performance and financial reports, they are going to analyze independently. They are not relating to the company related persons, are not relating to the investor one person. General way they are going to analyze, and they will decide the composition of the company. So once they deciding that rating, they can giving guiding to the investors whether to recommend that buy or sell of the securities. So that is the meaning of credit rating. Importance for lenders. Credit ratings helps to lenders decide whether to invest or lend. So high rating assure that safety and timely repayment, and low rating that not safety and not proper repayment indicates. So simply it can say that based on rating, we are going to decide the company performance and company ability, and influencing the investment decisions. They can influence the investment decisions also. So next, what is the importance of borrowers? So companies with high credit rating enjoy the goodwill and easier to access loans, and lower interest rates facilitate the better financing option. So here it is benefited for the lenders, and also it is a importance for the borrowers also. So this is the importance for the lenders, importance for the borrowers. Borrower will get the loans easily with low interest rate and very small documentation process. And for the lenders, they can decide based on rating to buy or sell their securities. The nature of credit rating. See, these credit rating agencies and credit rating, first of all, based on the information only. The rating are rarely on both published and privileged for information, kept confidential by the agencies. So generally, a rating agencies, what they will do, the company related information they will take and they will analyze, and they are going to kept confidentially by the confidential also. So multi-factor evaluation. Generally, these rating agencies is one side and one factor they are not going to see it. That they're going to evaluate that entire company related main factors. The rating consider the management quality first, economic outlook, and other qualities factors, not just formulas. So all this they are going to analyze, and multiple agencies and monitoring. The issues may be rated by the several agencies with ongoing monitoring leading to upgrade the under downgrades. The issuer right to and rights and publications. The rating are published only with the issuer of approval. The companies can appeal the assigning the rating also. See, for example, if any company if they're performing well, and if they will not get any good rating, again they are going to appeal for the reissuing of rating also. That instruments rated and extended credit rating. See, rated instruments and extended credit ratings. Rated instruments are equity and preference shares, bonds and debentures, commercial papers and fixed deposits, and asset-backed securities, and individual borrowers. Extend credit rating system, country and state rating, and real estate and developers chit funds, bank and labor, LPG, liberalization, privatization, globalization, and Pearson dealers rating, structured obligation rating. See, rated instrument talks about the financial instrument, and this extended credit rating system talks about the macro level analysis. Credit rating methodology. Credit rating methodology, first one is the business risk analysis. They are going to analyze the business risk, examine the industry risk, what is the market position, what is the operating efficiency, and what are the legal factors are there. So that related all they are going to talk. First, business risk they are going to do analyze. After that, financial analysis they will do. So in financial analysis, accounting quality, what is the profitability situation, what is the movement of cash, and what is the flexibility of financial stability of the company. So these factors they are going to consider and they are going to analyze. Management evaluation. Reviews company goals. Generally, management evaluation means what? Whatever that reviews of company goals are there, they are going to whether they are achieved or not, what strategies are implemented by the management, and management what is the capabilities they have. So this is totally the top management level they are going to analyze. And next one is the geographical and regulatory analysis. This consider the location advantages, subsidiaries, and regulatory environment impacts. And this related location advantages, subsidiaries, and it means that particular place, if they start the company, is there any government benefits are there, and regulatory environment factors is there. So that all are going to done. After that, fundamental analysis they are going to do. They are going to analyze the liquidity position of the company and asset quality and profitability position of the company and sensitivity of interest and tax rates. So these all are that credit rating agencies they are going to analyze. So after analyzing this all, they will give the rating. What is the advantages of credit rating for the investor and companies? So generally, it is benefited to the investor. It is benefit both sides. Based credit ratings will give the benefit of. చెప్పిండు సార్ this is the both side, this is benefits. Investor point of view it is benefit, and company side also it is benefit. So first I'll explain what is the benefits to the investors. Assure that safety of investment. See, generally every investor main motto is what? Each funds he want to be safe, and also you want to get the maximum returns, you want to minimize the risk. So when there is a safety, it means it is reducing the risk also, and clarifies risk returns trade-off, and enable independent investment decisions. So based on that rating, as an investor I will take my decision. So that rating will give the clarity for me to take the investment decision, and relieves needs for the detailed company analysis. So continuous monitoring rating. So these all are benefit for the investor side. These all are benefits for the company side. Easier resource mobilization. See, if the company rating is very high, so financial institutions they can offer the loans very in low interest rates and lower borrowing cost. Borrowing costs they are not going to charge any processing fees, and they can reduce the interest rates also. Reduce the public issue of expenses. Encourage the growth and expenses. Those companies performing well, for them, this rating will help to expand and encourage the growth and expenses. If they will getting good credit rating, so automatically it can be encouraged to growth and expansion of the business. And recognition for the lesser known firms. So maximum in the market, many companies they are able to know about that company. What is the advantages of credit rating for the intermediaries and market? See, first of all, support to the intermediaries, and it helps to merchant bankers and brokers plan price underwrite under place of issue effectively. And risk monitoring enables brokers and dealers to monitor risk exposure efficiency and facilitate and scrutinization, assist special purpose vehicles in repacking repackaging of assets. Next one is the market benefits. Provide the reliable information and identify the strengths and weakness of the enhanced marketability and burden and burdens of investor base. So these all are advantages. What is the limitations of credit rating? See, non-disclosure information. Generally, whatever the analysis is done by the credit rating agencies, they will not they will not disclose. So incomplete or withheld information can mislead the investor, cause of losses. And static nature. This rating reflect that specific point of time and may not account for the future changes. So it means what? Based on recorded data and past data, they can analyze and they'll give the rating. But maybe in future, the company is going to change the performance. So it may go into the impact also. Not certificate of soundness. The ratings are opinion, not guarantees of the company's stability of soundness and potential bias and variabilities. The personal biases and differing agencies' judgments can affect rating accuracy and consist. Impact of unfavorable conditions. Sometimes rating may not reflect the true company strength if assigned during the adverse period. So these all are the limitations of credit rating system. So remaining chapters, next class I will going to explain.